Good evening, everybody. Hope everybody's having a nice spring evening. Tonight we have the honor of having Thomas Woods, who is the Director of Trading Operations at Microquant. And he also is the host of their futures trading room. And he has extensive background in researching and developing new technical indicators. So this is always very good information. The more information we can get about what makes prices move in the right direction, the better off we are. So with that, I'm going to introduce, I hope this is working, and we're going to introduce Thomas and welcome to the Candlestick Forum.
Hey, Steve. Thank you for that. Hello, everybody. We'll go ahead and get started here. Tonight we're going to be talking about trading momentum divergences using a couple different indicators. And they're really great way of trading, in my opinion. It's a great way of identifying turning points and potential pullbacks and retracements in the market if you're in a trending market, or finding strategic entry points into a trending market. So we'll go ahead and kick things off then and start talking about it. First, before we get started, just a generalized risk disclaimer. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. So, along the same lines, we're also required to show you the CFTC Rule 4.41. This is just a generalized disclaimer talking about how everything we're showing is for hypothetical example only. Now, even if we did participate in many of these trades, which we have, this is just for educational purposes only, basically. If you want a copy of these slides or these disclaimers, we'd be happy to send them to you if you send an email to support@microquant.com. And I'll show you that email a little bit later on. Now, after tonight's presentation, we'll also be giving you a special offer. We have a very nice discount available right now on the indicators. It's running through the end of this week. So I'll show you that at the end of the presentation. But first, let's go ahead and dive right in. Now, in my opinion, and Mark Helwig's opinion as well, many of the traders here at Microquant, there's really three components of technical analysis that you always need to be analyzing at any time before you place any trade. And those are price, momentum, and value. Now, those three things together, they end up making what we call the market, and they end up showing us where the market is, and that's how you decide what the current price of the market is worth, where you're getting in, where you're getting out. So you need to be analyzing all three of those things before you place any trade. Now, traditional price charts, which is what we've been using for the past 100 years or so, are what we've been using to display price. We also have momentum indicators to display momentum. And now with the introduction of value charts, we have a way to display objective market value. Now tonight we're going to be using a couple different indicators. We'll be using value bars and we'll be using NQ momentum. Now what value charts do is they plot price in one of 5 color-coded value zones, ranging from the center green area right here, which is considered fair value, and then above and below that we have moderately overvalued and moderately undervalued. And then above and below that, we have significantly overvalued and significantly undervalued, respectively. Now, historically speaking, you have on average about 66% of all trading activity is taking place within this fair value zone, and then about 16% of trading activity is taking place in this moderately over and moderately undervalued price zones, and then about 2.5% of trading activity is taking place in significantly over and significantly undervalued price zones. Now, the reason this is helpful is because it allows us to identify key entry opportunities where we are able to get into the market and get into realized gains or unrealized gains much sooner. We don't have to suffer through the unrealized losses that you otherwise would have gotten in if you had timed your entry wrong. Now what value bars do is they simply take this value chart, where this value chart is plotting price in terms of value as it moves through the 5 value levels. Value bars simply color code your price chart, your traditional open, high, low, close chart, with the same colors as value charts. So you can see here you're significantly overvalued right there. You're significantly overvalued on the upper red bar segment there. Moderately overvalued corresponds to the upper yellow bar segments here. Fair value is the green. Moderately undervalued is the lower yellow. And significantly undervalued down here is also significantly undervalued lower red on your open, high, low, close chart. So it's pretty simple how it works, but it's a great way of being able to see value and see price at the same time. That's why I like to use value bars. And it also helps us identify when the divergence could be getting ready to end or getting ready to actually roll over in our direction. Now the other indicator that we'll be using, because we're talking about momentum divergences specifically today, the other indicator that we'll be using is NQ momentum. Now if you're familiar with a MACD, this is set up in a similar fashion as an MACD, where you have a slow indicator line and a fast indicator line along with a histogram. And the histogram is showing the spread between the slow and the fast indicator lines. So you can see just how much strength the market has when you create a down move and how much strength the market has when it has an up move. So we'll be looking at both the indicator lines tonight and the histograms when we're trying to identify these turning points from these divergences. As always, there's a couple different rules you want to follow with this strategy. The first rule, and this I say for every person I ever talk to, for any of the students that I have over at Microquant, and it's always have proper stop losses. You never want to get into a trade without a stop loss. You're really asking for it if you do that. And then along those same lines, I want to clarify this as well. Make sure your stop loss is not a stop limit. Make sure it's a stop market. Because if you have a stop limit and the market spikes up like you saw soybeans do today, for example, if you have a stop limit and your stop doesn't get filled, then you'll stay in that trade and you won't get out of it. Now, if you use a stop market, instead of trying to get you out at a specific price, it'll get you out at a market order. So as soon as that price point's hit, it turns into a market and will get you out at whatever the market price is. Rule number 2 is don't rush your trades. You want to let the trade come to you. Don't feel like you have to be forced to trade anything. You need to be patient. One of the biggest mistakes that traders make is they're not patient and selective enough with their trades. So always look for the best trade opportunities that you can. And then don't chase after it. If you miss it, that's fine. There are always going to be another trade opportunity in the future. Another rule that we have for this strategy really is have a half profit target and then leave the second half one to catch a larger move. Now along those lines, you need to make sure you understand the overall direction of the market, what your outlook is. So if you think that you're long-term bullish and you're trading a bearish divergence, then you're expecting a short-term pullback to the downside, but you have to realize you're not going to try to let that run lower because you have a longer-term outlook that's going to go higher. Now along those same lines, if you're trading a 5-minute bearish divergence, the overall market might be heading higher, but if it's a 5-minute bearish divergence, so the market's come up like this, and then you've created a divergence here, and you're getting short right there, I would still expect it to come down, but my profit target is going to be reached much sooner because if a 5-minute divergence, I'm expecting it to go down for the next 15 to 20 minutes total, whereas if it's a daily divergence, I would expect it to go down for the next 2 to 3 days. So you can still trade these intraday pullbacks here, and we'll talk about that in a little bit, and still be very profitable doing that even if the overall trend is up. So you can identify when a market's getting ready to pull into consolidation. Yeah, for the outside ranges on value charts, it is roughly 2.5% of the time. Now that being said, you can look at your price action profile, which is another indicator that tells you exactly how often a market trades in each value range, and it differs depending on the market and the volatility in your settings. But some markets you'll get where it only trades maybe 0.9% of the time or 0.8% of the time in that significantly over and undervalued range. Now the last rule is stick to the strategy. If you have a strategy, you have it for a reason. And if you're not following the strategy, then you can't expect it to work for you. So you can't go and say, okay, I'm going to go trade this strategy and then not follow it and then be upset that it doesn't work. Make sure you're always following the strategy. You have it for a reason. Make sure you stick to the system and follow the rules. Now, what is a divergence? When I say we're trading divergences, what exactly is a divergence and how is this going to help you? Well, divergence occurs really when the price and the indicator are no longer correlated. So typically when a market is moving higher, your price is going to be going like this and your indicator is going to be going like this as well. A divergence occurs when they no longer are moving together. So your price will be going like this and your indicator will go like this. So you'll have higher prices with a lower indicator. And a lot of times that shows weakness. It shows that the market has jumped up and it could be running out of strength and beginning ready to roll over and go into consolidation or even reverse trend. So that's what a divergence is, and you can have both bullish and bearish divergences. Okay, so a bearish divergence is when you have higher prices with a lower MQ momentum reading. Now a bullish divergence is the exact opposite. That's lower prices with a higher MQ momentum. A lot of people always ask, they say, well, all right, that's great, you trade it in futures, but does it work in any other market? Yes, divergences work on any market that you trade, whether that be equities, futures, forex, etc. They all work. So I have examples tonight, and I'll show you some equities. I'll show you some in Apple. I'll show you some futures. I'll show you some divergences, both bullish and bearish in crude oil. And the same, I'll show you some forex. And I'll show you on a lot of different time frames as well. So, because remember, if you're trading a 5-minute divergence, you still expect it to come down for the next 10, 20 minutes, or 2 to 3 bars, 2 to 4 bars. And the same goes for if you're trading a daily divergence. You would expect it to come down or go up for the next 2 to 4 days. MQ stands for Microquant, which is the company that created value charts. Now, here's an example of a bearish divergence. So you can see here, when you're looking at the divergence, you're looking at high number 1, which is this high here, and that corresponds to all of these all these up histogram bars here. So green is upward momentum on the MQ momentum indicator. Red is downside momentum. Now you're also looking at this entire high here on your indicator line. High number 2 is equally as high, and it's significantly overvalued. Remember, upper red means significantly overvalued. So you're significantly overvalued, you're equally as high. Then you look at your momentum indicator, and you can see there's a big difference. Here is your first high. You're much lower here on your indicator line, and you're much lower from the high of this rally, the high of this rally. So you have a bearish divergence, so you're going short right up here and overvalued with your stop above the previous high, and then you're looking to catch this downside move. Now remember how I said you always have to have a half profit target. You have a couple different options for your half profit target. I have 2 different options that I typically use. The first one is the 8 exponential moving average. Now I use that a lot of times for candlestick reversals and for other strategies that we trade, but I use that, I call that the gravity line. When a market has pulled back, as soon as it hits that 8 EMA, that can be your first profit target potentially. That's also typically where I'll put my stop at break even. The second profit target, or if you don't want to use the 8 EMA, you want to give it a little bit more room, is undervalued. So if you got short at overvalued, you're taking off half as soon as you get down into undervalue, which is the lower yellow or lower red bar segments. Okay? Then the second half you're leaving on for the longer term move until you have the reversing, until you have a reversing divergence like you did here, which was low number 1 and then low number 2. You look at your indicator, low number 1, low number 2, significantly higher, even though prices were lower. So remember that they diverged. Prices continued down even though the indicator can back up. So you're then reversing that second half. You're closing the second half here, and you're going long. And you're catching this move up there from the bullish divergence. Now here's another example of a bullish divergence once again. This is in crude oil, by the way, on a 5-minute chart for those of you that are wondering what market I'm looking at. Here you can see, remember, you're looking at low number 1, which corresponds to this entire down move here. And then you're looking at low number 2. You came all the way down, significantly undervalued. You had lower prices, so the prices were still lower. And then you look at your indicator, you can see you had a significantly higher low on your MQ momentum histogram and on your indicator line. And here in just a minute, I'll tell you which are the highest probability divergences versus the lower probability divergences. So you'd be getting long at undervalued. As soon as the price hits either the 8 EMA or the opposing value level, your stop is going to break even and you're taking off 1/2. And then as soon as you get the bearish divergence, right here, where you had higher prices, a lower high indicator and histogram, then you're taking off the second half and potentially reversing. Okay, so does that make sense? I want to make sure, I'm going to stop and take questions every once in a while to make sure everybody understands what I'm talking about when I say a divergence and how you're identifying it. So now what are the higher probability versus the lower probability divergence patterns? Everybody wants to say, I only want to trade the highest probability divergences. I only want to trade the trades that have the highest probability of success. Because we all know as a trader, your goal is to have the probabilities in your favor. So the higher probability using NQ trend or NQ momentum is a no return divergence. I consider this the highest probability because we typically have the highest success rate. When this happens, normally you're going to get a fairly decent sized move in your direction. Now, a no return divergence is when the momentum never recovers from the initial move down or up. The medium or middle risk or success rate for divergences is a broken divergence. And that's what we're looking at right up here, a broken divergence, where you had downside momentum, then you went all the way back up to upside momentum, and then came back to downside momentum. So it was broken by this upside momentum area right there. Okay? And then you have a connected divergence. That's the lowest probability, but they still work. And that's when you have a steadily rising or falling momentum without changing to the opposing momentum side. Okay? So here is an example of a no return divergence. Here's high number 1. You can see a very nice up move in your momentum. And then you came all the way back up, moderately overvalued once again, equally high highs, and actually broke the previous high, and you had no upside momentum when it rallied back up. So it stayed red the entire time. So it went back to downside momentum, never got back to upside momentum, and then continued on. You can see this sold off fairly well down your direction. So this is the highest probability, in my opinion, for success with a no return divergence. Now, separated divergence, as I mentioned before, you're separated by the opposing side of momentum. So here's your high number 1, corresponding to high number 1 here. And then here's high number 2, corresponding to high number 2 here. And you're separated by this entire down segment of downside momentum. So where the bars went green, and then back to red, and then back to green again with a lower high. So you stayed lower than this high was. That's a separated divergence. That's about the middle, and you see these more often than the others. Now, the last one is a connected divergence, and a connected divergence is this right here, where it stays green the entire time or it stays red the entire time. These are the lowest probability of success in my opinion. However, they still work fairly well. I typically try to only trade the broken or no return divergences. Does that make sense to everybody? Where is the entry point on the trade? I'll talk about that in just a moment when I get to the examples. So I'll answer a couple questions really quick. We're not using candles. We're using open, high, low, close bars, so we can use value bars, which are painting the bar segments the correct color according to the value level. The algorithm is somewhat correlated to Keltner channel and Bollinger Band. Not at all. Now, Bollinger Bands are designed, and you can go read this on the Bollinger website, they're designed really to show you extremely overbought and oversold conditions. What value charts are doing is they're taking it a step further, and they're adjusting according to the volatility and then showing you exactly how overbought and oversold or overvalued and undervalued a market is. So it'll go one step deeper in showing you exactly how often a market trades in each area. The moving average on the price chart is an 8 exponential moving average. So an 8 EMA. And yes, you can use other oscillators for identifying divergences. I just use MQ momentum. Personally, it's my favorite indicator. I also use MACDs occasionally, to be honest with you. There's nothing wrong with using MACDs or using stochastic slow or stochastic fast, other indicators like that. So here's an example of a bearish divergence. Remember, higher prices with a lower indicator. You can see here's high number 1 and then high number 2. So you had a higher high. You look at your indicator, high number 1, high number 2. You have a lower high on your indicator. You can see this sold off very well. Now, the question was, where's your entry point? So when do you want to get into this? You're looking to get in it as soon as it breaches or reaches the previous high. And you also want to see it overvalued. Okay, you see how it has the upper yellow bar segment? You want to be getting in, if you're going short, from an overvalued price point, just like you want to be getting in if you're going long from an undervalued price point. So you can see here you are overvalued, upper yellow bar segment, equally high and just barely broke above the previous high in a lower high indicator. The reason you want to be getting in on the right side of value, so getting short from overvalued or getting long from undervalued, is because then you know, statistically speaking, you have a higher probability of the market moving your direction much sooner. So you're saying, okay, it's already overvalued. It only trades up here a small percentage of the time. So we have a higher probability of it getting ready to turn around and start heading lower very soon. You can see, so you're short from up here. First profit target is undervalued. So this is your first profit target right there. That's a fairly nice move. The second profit target is the longer term trade. So you leave the second half one with a break-even stop. You catch this entire down move until you have this right here, bullish divergence. You can see you came all the way down, significantly undervalued at that lower red tip, just about equally low lows, but you can see you never came back down into downside momentum. You stayed green the entire time, so you have the okay to go long. So then you're covering your second half of your position, and you're reversing your position going long. So a great, great trade in both directions, both short and then reversing going long. Now let's take a look. You said, okay, that's a 15-minute chart. Let's go ahead and take a look at some longer charts. This is a 30-minute chart for crude oil, and I'll go all the way out to dailies and weeklies, by the way, as well. So you can trade this all the way down to a 1-minute chart. You can even use tick charts. Divergences work extremely well in ticks. And then you can also trade dailies and weeklies if you want to do longer term. Just depends on the type of trading you want to do. Some traders like doing swing trading. Some like doing day trading. So the first one we have here is a bullish divergence. The first low corresponds to this low here, which is this low here on your MQ momentum. The second low, you came all the way down, moderately undervalued once again, as signified by the lower yellow bar segment, just about equally low prices, so you were just about to the same low as the previous low. You look at your momentum indicator, you have a significantly higher MQ momentum indicator line and a significantly higher MQ momentum histogram. So you have the okay to go long. First half comes off as soon as you hit overvalued. So there's your first half. This is your first trade. Very short trade. It lasted about an hour. The second half stays on until you have the divergence in the opposite direction or until you reach a profit target from a trend line or another valid reason for getting out. The next divergence we have here is a bearish divergence all the way up here. By the way, you could have also considered this a divergence, high number 1, high number 2, equally high with a lower high indicator, and that still sold off all the way down to your first value target. But here's the next very obvious divergence. This is just a great, great divergence here. You have your first upsurge here, which corresponds to this entire up move here in your momentum. Then you have your second high here. You went even higher, all the way up to significantly overvalued, as shown by the upper red bar segments. And then you look at your indicator and you go, wow, there's no momentum at all in this rally. So you have the okay to get short. You're getting short just about from the high of this. This is all the way up at 97. And this sells off. You hit undervalued right here at about 96.25. So that right there in crude oil is about $700 a contract worth of a move that took about 3 hours, 4 hours to get to. That's your first profit target and your break-even stop. The second profit target is when you have a divergence in the opposing direction or when you hit a valid point in the market to get out, such as a support or resistance level or a trend line. Now remember, the overall trend is up in this market here at this time. So the market could continue to go higher for quite a bit more. I mean, this market could have continued to go way up to $100 an ounce, which I don't think it did, or $100 a barrel. I don't think it did. I think it sold right back off here very soon. But just because the trend is up, there's still plenty of money to be made taking these counter trend reversals when the market goes into consolidation. And you can identify many of these opportunities by trading divergences. You can also find great entries into the trend by finding bullish divergences in the direction of the trend. Let's take a look at another example. I have a lot of chart examples, by the way, both in equities, equities, futures, and in Forex. This is crude once again on a 60-minute chart. So you can see here, remember, high number 1 corresponds to this entire set of highs here. High number 2, you come all the way up, you hit moderately overvalued, you break the previous high, you look at your momentum indicator, lower high indicator line, much lower high indicator histogram. So you have no upside momentum even though that market came all the way up there. This ended up selling off quite a bit. Very nice move to the downside there. Now, I'm not going to sit here and tell you that every single divergence plays out. I don't want to steer you wrong like that at all. You can see right here is an example of a divergence where you probably would have gotten stopped out. Right here is low number 1, corresponding to low number 1 here. Here's low number 2. You came equally low. You had a higher low indicator. Okay, it still got a little bit of a bounce, about 20 ticks or so in crude oil for the next hour or two, but then it came and rolled back over. Now remember, initially when I started the webinar, I said you're looking for it to move over the next 2 to 5 or 2 to 4 bars in your direction. If the market doesn't move in your direction significantly in those 2 to 4 bars, you probably want to get out of the trade, even if it hasn't hit your stop loss. And the reason for this is because with a divergence, you're essentially picking the exact top or the exact turning point or bottom, the turning point in that market before it moves in your direction. So if it's not really quickly moving back in your direction, then it might not be playing out correctly. Now, this is another reason why using value charts to time your entries helps quite a bit. Because if you're getting in only when you're undervalued, if you're getting long only when you're undervalued, that means you're only using a stop loss that's risking 5, 10 ticks at the most. I know in the trading room, myself, we try not to ever risk more than $250 on any contract, per contract in any trade. And typically we risk half that on every trade. So you're able to use a much tighter stop loss when you're timing your entry based on a value-based entry. Okay, let's go ahead and move on, look at another example. So we're getting longer time frame. Remember, the no return divergence are the highest probability of success, and typically when you get a no return, you're looking for a very big move in your direction. Well, you can see here a great bearish divergence. Here's your high number 1, corresponding to high number 1 here. And then high number 2, moderately overvalued. You can see right there, you're overvalued on those bar segments. Equally high and barely broke the previous bar's high as well. So barely broke the previous high's high. No upside momentum at all. Market stayed red the entire time, sold right off and fell right through the floor. This was from 97.40, and this dropped all the way down to a low of just about 95.40, so about $2 a barrel worth of a move. And that is $2,000 a contract, and you would have been able to risk about $150 a contract on that trade. Let's look at the crude one more time on a daily chart, and then we'll switch over and look at some equities. I'll also try to answer a couple questions before we start looking at Apple. This is crude on a daily. Now remember, if you're trading a daily, your stop is being placed the same distance, meaning your stop is going above the bar's high, which on a daily chart, the high is going to be much further off than if you're using a intraday chart. That's why I drilled down on everything. Remember, your targets are the same too. If you're short off the daily high, your first profit target is undervalued, which is right there. So here's the bearish divergence. Let me point this out first. High number 1, so H1, and then high number 2, H2, high number 1 corresponds to the high there. High number 2 corresponds to this high here. You're going from the highest bar on that rally. So that bar compared to this bar, you're lower. And then you look at your indicator line as well. Your indicator line is much lower. So you have a very nice bearish divergence, and you came all the way up significantly overvalued. And you can see how often this market is traded in significantly over and undervalued. There's the last significantly overvalued price bar. Here's the last significantly undervalued, significantly undervalued, and significantly undervalued. Now, I know you're sitting there saying, well, the whole time that market was trending down, it stayed undervalued, or the whole time that market was trending up, it stayed overvalued. That's exactly right. You're not supposed to just go in and buy and sell the value levels arbitrarily. You need to take them within context of what the overall market is doing. So you need to make sure you have a valid reason other than just the fact that the market's overvalued. Now, that being said, occasionally you can find markets like on a daily, or when you have a daily significantly overvalued price bar, a weekly significantly overvalued price bar, and an hourly or 240 overvalued, significantly overvalued price bar, it'll trade there maybe 0.1% of the time. So very, very rarely, and a lot of times those are great entry opportunities for shorts or longs. Okay, so there's high number 1, high number 2, significantly overvalued, so you're getting in at the appropriate value level. Your stop is going to be on the high of the bar, and every single time I might see a daily bearish divergence, I'm not going to trade that divergence off the daily. I'll drill down and find a divergence on an intraday chart. But you can see here, your first profit target was hit at moderately undervalued. which is at 98. So you're short from roughly 103. Your first profit target is 98, so that's $5,000 a contract that you made in the very next day. Then your stop goes break even, and you stay in it until you have a divergence in the opposing direction. So you're staying in that, and then you're reversing here, because here's low number 1, which relates to low number 1 here, and then low number 2, where you came all the way down, significantly undervalued once more at that lower red bar segment. You see much higher low on your histogram on your MQ momentum. So your momentum was much higher, even though prices were lower. So your first short was all the way up here. Here was your first profit target. So that's profit target number 1. That was $5,000 a contract worth of a move. Here's profit target number 2. All the way down when you're reversing and going long. And that right there is about $13,000 a contract worth of a move. And it took you 2 weeks to get there, maybe 3 weeks to get there. So that's a swing trade. Of course, this is off of a daily chart. So remember, if you're trading off a daily, you're expecting it down over the next several days. Trading off a 5-minute, you're expecting it down over the next 5 minutes. Now, you reversed here. Your first profit target is right there. So now you reversed and you've gone long. You hit your first profit target and then you put in a break-even stop. So you hit overvalued right there. That was your first profit target. That was about $4,000 a contract worth of a move to the upside. Then you're staying in it. You probably got stopped out with the second half at break even. So still not a bad trade whatsoever. Any questions about the futures and about those examples we just used in crude oil? Okay. Don't see any questions at the moment. What was the date of that high in oil, please? That was, oh, I don't know the high on it. If you pull up your price chart, you should be able to find it, honestly. I accidentally have the dates blocked out a little bit at the bottom. Adding candlestick patterns to divergences can improve signals. Absolutely. Adding candlestick patterns to divergences is doubles the probability of success. I'm a big fan of candlestick reversals. Trade them all the time. Can you use candles rather than open high-low close? Absolutely. The indicator works the same. This is just a different way of showing it. And you can still use value charts to show the value levels with a candlestick. I just like doing it this way because it puts the value levels on top of the bar chart. You said that high was 9/14/12. Thank you, Sam. How did you pick the low to use? Because you hit significantly undervalued. You picked this low here because you hit significantly undervalued, which is that lower red bar segment, and then you looked at your indicator and you were much higher compared to this previous low. That's how you pick the low. I just use a standard MACD settings when I use a divergence in MACD. Okay, let's keep on going. We'll move on. We'll have a time for a Q&A at the end of the session as well. As long as Steve doesn't mind, we can potentially run over a little bit. I just want to make sure we get all the basics covered, and then we can answer as many questions as you have, hopefully. So let's take a look at some equities, because I don't want you to think this only works in futures. This is Apple. Okay, we'll look all the way from a 30-minute all the way out to a weekly chart. So you have a bearish divergence here in Apple. Okay, this is actually just from a couple days ago. Now remember, the trend is up. Now this actually is a couple more of our indicators. The red and green line you see here that looks like a moving average, it's not a moving average. That's called MQ regression. It's a very simple trending indicator. You can see red is downtrend, green is uptrend. The red dots and green dots you see are called MQ trend, and red dots mean downtrend, green dots mean uptrend. When you have both of them in the same direction, a lot of times that gives you great opportunities to get long at undervalued and then cover it overvalued, so do a value range trade. Now remember, you can still go counter trend because you're identifying when a consolidation period is going to occur. And that being said, that's why you have the value targets and your break-even stop targets. So we have a bearish divergence here where we came up. Here's high number 1, corresponds to that entire up move there in Apple on the 30-minute chart, which is that high, that up move there on your momentum. The high number 2 is right here. We came all the way up, moderately overvalued. You can see we had equally high prices. So you're getting in, by the way. You erase some of this writing. You're getting in as soon as you get equally high or within just a couple ticks of the previous high. So you can see you were just about equally high and you were moderately overvalued. So you want to have all that criteria met, moderately overvalued or significantly overvalued, and you want to have it equally or just above the previous high, and that's when you're getting short. You have a lower high momentum histogram and a lower high momentum indicator line. You still had a very nice pullback. If you were getting in while you were up by equally high, then you're in it around 445 area, and this came all the way down to undervalued here, which is your first profit target and your break-even stop target at around 439. So you still had a fairly decent sized move that only took about an hour and a half to get to. So a very nice trade there. Again, that's completely counter trend, but that's okay because you're looking for the consolidation period. And then what you could be doing is watching for the breakout of that consolidation to get back long again. So you can also use this if you have a net long position or a net short position, you see a bullish or a bearish divergence, then you can use this to time when to cover, and then you can try to get back in at a lower price and take out even more of the market, by the way. So a lot of times that's the way I use it. I'll have a net long or a net short position. You'll see a bullish or a bearish divergence in the opposing direction. You'll cover, watch for the market to consolidate, get back in at a lower level. So I'll cover up here because of the bearish divergence. Wait for the market to go into consolidation. As soon as it breaks out of consolidation, I'll get long again, and that means I've locked in this additional profit from that move right there. Okay, let's take a look at a longer time frame. Let's look at a 60-minute chart. This is Apple once again. You can see high number 1 is that high right there. High number 2 is this high right here. Look at your momentum histogram. So again, high 1, high 2, equally high prices, significantly overvalued. You look at your momentum histogram, lower high indicator line and lower high histogram level. So you have the okay to get short. That got you short right up around 463 roughly. Your first profit target was down here at 460, so you took about $3 a share out to the downside there. And then you also were able to catch the rest of the down move until you had the bullish divergence, which you didn't have for quite a while. So very nice trade there. You identified basically the exact top. This is where you can also look to be adding candlestick reversals in as well. We do some candlestick reversals. We would have called this right here a golden doji, where the entire thing was moderately overvalued and it was a doji pattern, pulled away from the 8 EMA at the high of the previous bar, and it had a bearish divergence. So that would have been the best entry bar for you. So that's a 60-minute bearish divergence. Again, lower high indicator, higher high, or equally high prices. And this right here, by the way, is an excellent example of why you don't just buy value arbitrarily. What this is called is a value migration. And when that occurs, it's actually a good sign for the bears because it shows that there's a lot of strength and a lot of momentum to the downside. Just like when you have a value migration to the upside, and you see overvalued, 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 that shows a lot of strength to the upside. So this is why you're not just buying or selling just because of the value level. You have to have other valid reasons. You have to have an outlook. You have to have a divergence. You have to have other reasons for taking the trade. This is just guaranteeing you basically, or helping you identify a precision entry where you have a higher probability, you have the odds in your favor of the market moving your direction very soon. A value migration is when we're back here, when the market was trading right in this area, this was significantly undervalued. But the market is moving to a new value level. So what was once significantly undervalued is now going to be the new fair value. And you can see value charts will adjust with time. You just have to give them a little bit of time. And depending on your settings, you can use longer settings or shorter settings to make them adjust sooner or slower. Okay, let's go ahead and take a look at the 120-minute chart here in Apple. Again, here's your bullish divergence. Excellent, excellent entry opportunity here. You can see low number 1 and then low number 2. So you had lower prices, significantly undervalued right there. See the lower red bar segments. Then you had low number 1 here, and then low number 2 here. Significantly higher lows on the momentum indicator. Significantly undervalued price paired with the lows. And then you also had a spinning top, just about a doji, which is showing neutrality in the market. And then you have a red jacket, what we call a red jacket doji. And you can see this shot straight up from there. So remember, first profit target is moderately overvalued. So let me try to draw this out for you a little bit. Here's your entry, right down here. Here's your first profit target. So there's profit target number 1 and break-even stop. One of the reasons I like having half profit targets is because that allows you to have losing trades and still pay for them, basically. So you might get stopped out break even, but you've already locked in some of those gains. So even if the market comes against you, you've still paid for it. If you are only ever putting in break even stops and you have the market come against you a lot of times and you never lock in any of your gains, you might have several very profitable trades, but you never locked in any of the gains, then you won't have anything to offset your losses. Okay? Here's the next exit opportunity and second profit-taking opportunity. So this was your first profit target right there. Very nice move. I mean, that's still about, call it $8 a share worth of a move that took one afternoon because you gapped all the way up. And the next day, actually, you probably would have gotten out all the way up here at about plus $10 a share because it gapped up the next day and you would have said, wow, I'm all the way up and overvalued already. The second opportunity, profit-taking opportunity, significantly overvalued, higher high prices. You look at your momentum indicator, look at the weakness in momentum that you experienced on that rally. So now this is your second profit and reversal. So now you've taken out about $40, $40 to $50 a share, and you're reversing, and you catch this entire down move here as well. This is why I like divergences, because a lot of times they will identify precision turning points in the market. I mean, very, very precise. And when you pair them with candlestick reversals, that can be even better. Let's take a look at Apple on a daily. Okay? This is all the way up at the 700 level, by the way, when everybody was guaranteeing that Apple was going to be the $1 trillion market cap, that it was going through the moon, $1,000 a share. Didn't happen, as we all know, so far. But you could have identified this exact top on your daily and on your weekly. So here's high number 1, corresponds to high number 1 here. Here's high number 2. And then you pair that with your candlestick reversal patterns, by the way. If you like candlesticks, you had a shooting star right there, what we call a yellowtail shooting star because the upper tail of the shooting star pattern was yellow. Lower high histogram, as you can see here. Lower high indicator line. Very nice entry opportunity. You were also significantly overvalued at that high or at this high. Any of those would have been excellent points to get in. You could have caught that entire down move there in Apple off the daily chart. Okay, let's go ahead and look at the weeklies now. Now, this is weeklies. I mean, this is just excellent example in my opinion. So here's high number 1 on the weeklies. Here's high number 2. Look at your momentum again. Significantly lower momentum. And then you also had an evening star pattern. If you're trading candlesticks, you had an evening star, which is when the market gaps up. Let's see. So you have your up bar. Market gaps up higher. You have a doji basically at the gap up and then gaps down the very next bar. So you have a down bar, the very next bar. Very bearish sign, very bearish signal. Paired with the bearish divergence, even more of a bearish sign. You see that market, as we all know, Apple sold all the way off from 700. And then you had a weekly bullish divergence right here just a few weeks ago. So again, here's your sell signal. First profit target's down here. That's already right there, almost $50 a share. Second profit target is a bullish divergence all the way down when you reverse your position at the lows down around $320 a share that you took out till your second profit target where you reversed it significantly undervalued paired with the bullish divergence compared to those lows. So low number 1 is this entire down move, which is all that downside momentum. Low number 2, right here, significantly higher, significantly undervalued price point. That rally right up. Here's your first profit target. And we actually talked about this in my trading room as well. How you had a yellowtail shooting star right there for a downside reversal, and Apple sold off. So it was last week, $10, $20 a share in a matter of 2 days, right after we called that out. So great trades there on Apple off of a weekly basis. Let's go ahead and move on to Forex. And we'll also, again, at the end of it, we'll try to do a lot of Q&A, or as much as I can, much as Steve will allow me to do. So let's go ahead and take a look at Forex. So this is Euro US dollar. Okay, remember, no returns are the best ones. Whenever I see those, trade them all the time. They're excellent trades. So remember, high number 1 relates to high number 1 here. High number 2, equally high prices and barely broke above the previous high, moderately overvalued as shown by the upper yellow bar segment. Look at your momentum, no upside momentum at all. Okay, no upside momentum, you're still in down, still in the red. This sold off all the way from, let's call it 1.302, all the way down. First profit target was actually the same bar. So this was in a matter of 30 minutes maybe that you had a very nice move to the downside there. Probably about 40 or 50 pips. I don't really want to do the math at the moment. Can't really see it. You also had, by the way, this is another signal. It's not a divergence, but you had another no return. It's what we call a no return yellow hat, where you come all the way up, overvalued with no upside momentum. That's still a sell signal. The divergence is better, where you have equally high prices, but this one, still a very valid sell signal, where you're overvalued according to value charts. Upper yellow bar segment, lower, you look at your momentum, still in downside momentum. A lot of times that's a great entry as well. That's a topic for a whole another day. Then you can come all the way down. So your first profit target, there's your short entry. Here's your first profit target right here. Okay, so there's 1/2. Your second profit target is off the bullish divergence here. So this down move is down low number 1. This one here is low number 2, corresponding to low number 1 here and low number 2 there. Much higher low on your momentum histogram, much higher low on your momentum indicator, equally low prices, and you had a doji pattern which signifies neutrality or indecision, but paired with a value level of undervalued. We call that a yellow tip doji, so you have a higher probability market heading higher. You see you moved right up from there, so this was your second profit target. So there was profit target number 1, profit target in reversal number 2, all the way down here. And you took out about 1,500 pips to the downside in a matter of a day and a half, 2 days. So great trade. Please show today's soybean chart. Today's soybean chart actually, as soy went through the roof today. It was trading, this is off topic, sorry, getting off on a rabbit trail. But soy, we've been following this today for a while in the trading room. Soy's been over the past several days trading in a 240-minute channel, just like this. And we've been saying, if soy breaks out of that channel, watch for it to run. Well, soy took off today and jumped about 50 cents. What, an hour, if that? Jumped about 50 cents. It hit significantly overvalued all the way up at the high on a daily, on a weekly, on a 240, on 30, all your intraday basis and all your end of day basis, and then immediately sold all the way back off back into that channel. So excellent trading opportunity, and we've been waiting for that to happen now for the past week and a half, basically. We've actually been bullish and had a long-term bullish outlook on all the ags ever since they bottomed out on weekly support from that major crop report. But again, sorry, off on a rabbit trail. Different topic for another day. So let's look at the Euro-US dollar on a daily chart. Look at this, by the way. Low number 1, which is this low right there, corresponding to this low right here on your momentum. Low number 2, you came down equally low, and if you look, I don't know if you can really see it, but that low down there, probably only the bottom pip or 2 is moderately undervalued right there. So barely touches moderately undervalued, equally low prices. Excellent entry opportunity. I mean, you have basically no risk with that trade. If you're getting in and filtering your entry by value, that means you're getting in literally almost to the tick in that trade. Getting long, no downside momentum. As you can see, you stayed green the whole time, even though you had equally low and lower prices. That immediately took off. The same day you hit your first profit target, which is moderately overvalued. So here's trade number 1. Your exit in reversal is all the way up here at the bearish divergence at the high. So this is high number 1, corresponding to high number 1 here. And this is high number 2. Significantly overvalued once again. You can see the upper red bar segment. And then you look at your momentum histogram and indicator line. Your indicator lines are about equal, but your histogram significantly lower. So then you're closing your long and reversing. So again, here's trade number 1, half profit target. Trade number 2, all the way up in reversal to the short from significantly overvalued right there. And then you're catching this entire down move here. Here's your first profit target, and then you look for the bullish divergence to cover and reverse for the second profit target. So great trade opportunity there in the euro dollar on a daily. So that's all the chart examples we have. And actually, we're running right on time, basically. This gives us about 10 minutes to do Q&A. Before we do Q&A, this is the discount that we're offering, and this is only good until Sunday. Now, we have a 50% off discount for eSignal, for the indicators for eSignal and Thinkorswim. Okay? The coupon code that you use for that, the discount code you use for the 50% off eSignal and Thinkorswim is BCLaunch50. Now, the reason we're giving 50% off only for those two is because originally when we launched TradeStation, NinjaTrader, and MultiCharts, we gave a 50% off discount, so we wanted to do the same thing for those of you that have been waiting for the indicators to become available on your platform. Now, since we're giving the 50% off discount on those, we also wanted to give a discount for TradeStation, NinjaTrader, and MultiCharts. For those of you that hadn't heard of the indicators yet, we have a 30% off discount code for TradeStation, NinjaTrader, MultiCharts, and you can use the discount code BCSpecial30. Now, there's 3 different bundles when you go to purchase. The first bundle is the small bundle, which only includes value charts and the value chart scanner. Then you have the medium bundle, which includes a couple of the value charts indicators. And then you have the large bundle, which includes all the MQ indicators, such as the MQ trend and MQ regression. So here's the MQ trend, those red dots saying it's in a downtrend. MQ regression, the red line saying it's in a downtrend. Also includes MQ momentum and 5 or 6 other MQ indicators, as well as value bars. The only way you can get the MQ momentum and the value bars indicators are through the large bundle. So large bundle is $19.99, which honestly, if you think about it, really not that much, considering that you can make that in an hour on one trade, trading one contract. You should have been yesterday in the futures trading room. We had one guy was up $7,000 on one trade in a matter of 45 minutes off of what we were talking about tonight, by the way. Bearish divergences. We had shorts in the high in Euro yesterday, shorts in the high in gold yesterday, shorts in the Aussie yesterday, all off of bearish divergences, all from the highs. Excellent, excellent. You're saying the large bundle is the best. I tend to agree because all the indicators I use to trade are in that large bundle. The medium bundle, so this is the large. The medium is $9.99. Again, this is before discount, so you get much cheaper price. Then the small bundle is $4.99. Again, the momentum indicator, the MQ momentum, and the value bars, they're only in the large bundle. So, can I please show the charts as they appear on eSignal and TOS? I don't have a picture of eSignal or TOS right now. We'll go ahead and do some Q&A. I'll leave this up here so you can see the discount codes. Again, for eSignal or TOS, it's BCLaunch50 is the code. And for TradeStation or any of the other platforms, NinjaTrader, MultiCharts, etc., it's BCSpecial30. Okay, so let's see. Does this work with Sierra? We are actually in development for Sierra charts right now. So it's being worked on. We're looking to release in Sierra next week. How much money did he risk to make $7,000 on the one gold trade? He risked $400 on the initial short. And what he did, and this is one of the strategies we talk about in the trading room, with the way that we run the trading room is every time we take a trade, we explain why we did it, explain what we were looking at, the strategy we're using, how you can trade it, how you can manage it, all that kind of good stuff. The way he traded that, and this is the same way that we traded it, so we had the bearish divergence in gold. So gold had a huge bearish divergence, and then it came back up and had another bearish divergence within the divergence. So we drilled down and found a very short-term divergence. He got short right here on the short-term divergence right before gold fell through the floor. He risked $400 on the original 2 contracts. And then every time gold bounced, we were looking at tick charts. And every time gold went down and bounced up into overvalued again on the tick charts, on a 250 tick chart, every time it hit overvalued, he added a contract short. So it went up, bounced, add a contract. Went up, bounced, add a contract. And then we had a profit target of a trend line that was coming across the lows. That ended up being about $35 an ounce below where we were, and he kept adding contracts every time it would bounce. As soon as it hit the trend line or the profit target, he closed the position. He was up $7,000, risking $400. So great. I mean, that was just a textbook trade. Textbook trade. We also had shorts, by the way, for swing trades 2 weeks ago, almost at the highs off of a trend following value-based entry. Trend was down, bounced up overvalued. We got short right there. We risked $150. At one point, we were up $4,000. I mean, I was up $4,000 a contract at one point. And that trade ended up closing it, worked out fairly well. Now we're watching, for those of you that like the euro, by the way, this is, again, another rabbit trail. Euro's in a weekly head and shoulders, which is this pattern right here. Have a trend line coming across, which is a neckline. The euro just did this. So this is where we are right now in the euro. This is the neckline. On a head and shoulders pattern, when the neckline is broken, watch for the price to run. That's what we're watching for right now in the euro, watching that neckline. Value bars show overbought and oversold. Are they similar to Bollinger Band standard deviations? They are completely different than Bollinger Bands. Bollinger Bands are about 3 or 4 lines of code, just to give you an idea. Value charts are about 10 pages, and they are measuring completely different things. Value charts go all the way down into detail and tell you exactly how overvalued and undervalued the market is. Bollinger Bands are just saying, generally speaking, this is overbought territory or oversold territory. Please show the gold chart. I don't have my TradeStation pulled up right now, or else I would show you. I apologize. Trading room. The trading room is $149 a month. If you want, by the way, the place that you'll go to get all this, right here, valuecharts.com. This is where you can purchase the indicators, where you can find out more information about the trading rooms. If you want to come test out the trading room, by the way, send an email to support@microquant.com. We'd be happy to give you a free day or two to come in and watch. We have options trading room. We have a futures trading room, which is what I run at the moment. We also are getting ready to release a Forex trading room and an equities trading room. Can I please explain how this is different than MACD and a stochastic? How the MQ momentum indicator is different than the MACD and a stochastic. If you look at an MACD and put it side by side with the MQ momentum, okay, they're set up in the same way in the sense that they both have fast and slow indicator lines, and then they have a histogram plotting the spread between the two. The MQ momentum is much more reactive. Now you can adjust it so it's not quite as reactive, but it's much more reactive, and it shows the divergences much more obviously than a MACD does. Now that being said, there's still very valid reasons to use an MACD. I use an MACD every once in a while personally because I know that's a readily available indicator to a lot of people. So I want to use the one that everybody can get to. Here, let me really quick do this. Try to write with my mouse. Value charts. RTS.com. Excuse my handwriting with the mouse. I apologize. It's not that great. That's where you can go to get all these. The indicators work on NinjaTrader. Absolutely they do. You purchased a large bundle today. Will there be a training webinar on the settings you use for different time frames? Greg, send an email to support@microquant. Have them get you into the live trading room for a day for free, and I'll try to show you all the settings that I use. You can also ask them if you purchase a bundle and you send an email to support and tell them you want the PDF outlining the settings in the trading room. They'll send you a PDF that tells you all the settings I use. What do the small and medium bundles have? The small bundle only has value charts, and it only has value chart scanner. Doesn't have value bars, doesn't have the MQ momentum, doesn't have all the other indicators that we have, such as value levels, price action profile, any of that. The medium bundle has just a couple of the value charts indicators. So you have about 5 indicators in total. The large bundle has, correct me if I'm wrong, Mark, but I think it's around 30 indicators total. And it's all the MQ indicators. So you have trending indicators, you have momentum indicators, You have value-based indicators. You have indicators to help you understand when a value migration is taking place. Plus, you have all the value charts indicators. Let's see. Is this like market profile value areas? How is the value determined? I can't really get into a lot of detail on how value levels are determined because it's a proprietary algorithm. It's not at all like market profile. Market profile is showing you historical price ranges that have been purchased and sold off quite a bit. Value charts, what they're doing is, if you can imagine, here's a center line here, which is the center of fair value. And what sets them apart is a DVU, or dynamic volatility unit, that adjusts all these levels based on volatility of the market. But above and below that, you have one standard deviation above that and one standard deviation below that is moderately under and overvalued. And then two standard deviations above and below that is significantly over and undervalued. And these levels all expand and contract based on the dynamic volatility units. And then it also goes back and analyzes historically how often a market trades in each level. What markets are covered in the trading room? The futures trading room, we cover just about every single futures market out there. There's about 30 markets that we follow. The options trading room covers whatever. There's probably 30 different equities that they follow. Does this work with Metastock? Not at the moment. We're not on Metastock. Let's see. You have TOS. Will the software download directly in your TOS in your account as a study? I believe it will, Richie. Yes, I do highly recommend Steve's live trading. Their site, they are excellent. Steve Bigelow, he is the best, in my opinion, for candlestick reversals. I mean, he's an excellent, excellent candlestick trader. Let's see, can this be used on all U.S. stock symbols? Yes, it can be used on any over-the-counter traded market that you can plot price on. Where are the discount codes? Discount codes are right here. This is for eSignal and Thinkorswim. It's VC Launch 50. And the one for TradeStation, NinjaTrader, or Multicharts is right here. If you happen to be a Bloomberg terminal user, we're also, for those of you that are institutional investors, we're also on Bloomberg, but it's set up a little bit differently than how we are for the other platforms. So again, here's your two discount codes, VC Special 30 and VC Launch 50. If you have trouble with anything, VC Launch 50, VC Special 30, or you need assistance, go to valuecharts.com. There's a support number there that you can call, which those are during normal business hours on Eastern Standard Time, or you can send an email at any time to support@microquant.com. We'd be happy to help you out with anything. Do algos use this? It seems you can automate. Yeah, there are a lot of automated strategies that you can use. Can the software be loaded on the two computers? Yes, it can. We charge a $97 fee in order to add it to an additional computer. So if you have one computer, we'll activate it for that computer. If you want to put it on another one, we don't make you purchase it again. We'll just charge it's $97, and we'll go back on the back end and activate it for your other computer. Can you scan for divergences on TOS platform for stocks? No, you can't scan for divergences. You can scan for significantly and moderately over and undervalued price points, though. You use Metastock. As it's not available on Metastock, what other trading platforms can you use it on? We're available on eSignal, Thinkorswim, TradeStation, NinjaTrader, Multicharts, and Bloomberg. We're also in the process working on Sierra Charts, and we'll be launching for Sierra Charts in June. This discount code, it expires 11:59 p.m. this Sunday, so midnight this Sunday. You won't be able to use these discount codes again, and We are not ever offering another 50% off discount, by the way, for eSignal or Thinkorswim. So this is really your only opportunity to get 50% off. We're not doing 50% off for eSignal and Thinkorswim ever again, or for TradeStation, InterTrader, or Multicharts ever again. The only time we might do another 50% off is when we relaunch for Sierra charts. What's the difference between value charts and value bars? If you don't mind, I can go all the way back to the very first slide and re-explain that. Value charts and value bars are the exact same thing, okay? It's just a different way of plotting it. Let me see. You can see here with your value chart is plotting the bar intervals as they move through the 5 value zones. Overvalued, undervalued, significantly over, significantly under, and then fair value. Value bars, all they're doing is you see here when you are moderately overvalued here, they're just coloring your price bar the same color as the value level you're in. Then significantly overvalued, all the way up here, is the same thing as significantly overvalued up here. Here, here. Undervalued over here is the same thing as undervalued up here. So it's just coloring the price bar. It makes it really easy. It makes it very, very easy to see both price and value at the same time. That's all that value bars and value charts, that's the difference. It's not available in Schwab at the moment. Discounts should be available after being able to see them in action. I apologize. Like I said, if you want to see them in action, send an email into support@microquant.com. We'll get you access to the trading room tomorrow. The hours of the futures trading room are from 8 a.m. until 12 noon Eastern Time. The options trading room is from 9 a.m. until 1 p.m. Eastern Time. So come in tomorrow, send an email to support@microquant. We'll get you in there tomorrow so you can actually see them. Can you purchase directly through TradeStation on their strategy network? I believe you can, but I believe the price is much different, and you don't get the discount. You won't get the discount codes. You have to go to valuecharts.com to get the discount codes. The win trades in the presentation charts are retest market profile edge, equal highs or equal low trades, plus momentum divergence entries. That's exactly what it is. It's a momentum divergence entry with a value base. You're looking for momentum divergences with a value-based entry point. Are the divergence trades I demonstrated possible to do with the medium and small bundles? No, because you don't have. Well, they're possible, but you don't have this indicator down here. The momentum indicator, this whole section, lower section of the chart, you don't have that, and you don't have value bars. All you'll have is value charts if you purchase a smaller medium bundle. Is there any training that comes with the purchase of the largest package? I believe when you purchase the large bundle, you have the option to get into the trading room for a month for $30. I believe that's correct, so don't quote me on that. I think it's $39. They let you get into the trading room for an entire month. In the trading room, like I said, I try to explain every single thing I can so that you can understand why we're trading, how we're trading, and I try to answer as many questions as I can. What is the price of the trading room? $149 a month. Can you type in the email to ask for a pass tomorrow? Yes. When you send out an email, or just send an email to support@microquant.com. That's this email right here. The very bottom one, support@microquant.com. Send an email there. Ask them for access to the trading room. Tell them either you want access to the futures or the options one, depending on what market you trade, whether you trade options or futures. They'll get you access to it. Is it going to be on TC2000 soon? I do not use 2000 at the moment. You understand that they work on all time frames, but are they more effective on larger or smaller time frames? It depends on the type of trading you're trying to do. I wouldn't try scalping off of a 60-minute chart. If you're trying to scalp, then I would look to trade a much smaller time frame. It's not that one's more effective than the other. It's that if you think about it this way, okay, this is your 60-minute price bar, okay? There's your open, here's your close. Inside the 60-minute price bar, all you can see if you see the close of this price bar is that during that 60 minutes, it opened down here and closed up here. If you drilled down and looked inside of that price bar, that bar actually did this the whole time. Okay, it didn't just go straight up and straight down. It went up and down all over the place. So depending on the time frame you're trying to trade, just keep your profit targets in line with that, and the indicators will work the exact same. So if you're trading a 1-minute divergence, don't be expecting prices to drop 100 ticks off a 1-minute divergence unless you have a very bearish outlook overall, or rise 100 ticks unless you have a very bullish divergence overall. Let's see. Can I please show you the value charts once again? Absolutely. I'll go all the way back up. This is, all right, value charts. This picture of value charts is off of the Bloomberg platform, so it looks a little bit different than the other platforms because we were able to design Bloomberg from however we wanted to do it. We were able to fix the GUI however we wanted to with Bloomberg. Now, that being said, this is almost TOS looks the same way as this as well. TradeStation looks completely different than this. So be aware of that. Okay, I think that's about all. We're going to try to bring things to a close here. Again, if you have any more questions, feel free to send them in to support@microquant.com. We'd be happy to help you out. One more time, here's your discount codes. I want to thank Stephen below, and I want to thank Becky and Jim and everybody for having us here. Steve is one of the best candlestick traders I know of out there, so I would definitely, if you haven't already, go get in with some of his workshops, some of his webinars. He is very, very good at the candlesticks. So, Steve, thank you for having us. I appreciate it. Here's your discount codes one last time. For 50% off eSignal or Thinkorswim, it's VC Launch 50. For 30% off the TradeStation, NinjaTrader, or Multi-Chart platform, it's VC Special 30. Again, the large bundle is the only thing that has the MQ momentum indicator and value bars. But it should pay, I mean, honestly, in my opinion, it's a good deal because you should pay for it in a trade or two. It's entirely possible. So again, thank you all for coming. Go ahead and wrap things up.
Thomas, thank you very much.
Steve, you're very welcome. Thank you for having us on.
Yep, very good information. And everybody, this is why we like to have good speakers with good information, because the more information you can put into your mental trading computer head, the better off you are for creating situations where the probabilities are in your favor. So, Thomas, that was very good stuff. I hope we get a lot of people being active in it. So with that, everybody have a good evening, and we'll see you in the chat rooms.